If you use VA benefits and file taxes, 2026 is a seismic shift. The IRS and the VA are no longer operating in separate silos. They've just flipped the switch on a massive combined data analysis system, and it's already flagging new financial signatures that could trigger serious inquiries. This isn't about old-school audits. This is about predictive modeling. They are looking for patterns that suggest either benefit fraud or significant unreported taxable income. And the overlap is where most people will get caught. We're diving into the 7 new financial patterns flagged by this joint task force. If you recognize any of these in your own life, you need to adjust your strategy right now. You need to understand how the system views your finances when it combines your disability rating, your dependent claims, your Schedule C, and your crypto portfolio into one massive profile. This is the new reality of government oversight. Let's start with the biggest tripwire, your passive income. This is Pattern 1. The side hustle discrepancy signature. For years, many veterans receiving total disability based on individual unemployability, TDIU, compensation understood the rules. You cannot maintain substantially gainful employment. But the definition of employment has been stretched and broken by the automation economy. We're talking about income streams generated by YouTube automation channels, high-volume e-commerce stores, affiliate marketing platforms, or digital real estate ventures. These businesses often generate significant 1099 or Schedule C income, but the veteran claims they are passive or managed by a spouse or third party, thus not violating the TDIU rules. The new flagged pattern is simple: high volume, recurring 1099K or 1099 NEC income, flowing into an account primarily associated with the veteran, regardless of the business entity structure. The system doesn't care if you call it passive. If your business generates $50,000 in gross revenue and you are the sole signatory on the bank account, the algorithm flags the conflict immediately. It's comparing your VA status, unable to work, with your IRS filing, operating a successful business. This signature is particularly sensitive to patterns where the reported expenses are extremely low, suggesting minimal actual labor. Yet the gross income is high. The IRS is now cross-referencing the nature of the business, e.g. digital content creation, against the severity of the claimed disability, e.g. severe physical limitations. If you are claiming 100% disability due to mobility issues, but your business income suggests you spend 40 hours a week managing logistics or creating content, the system flags that statistical anomaly for review. This goes beyond simple income verification. It's a functional analysis based on financial footprint. Every dollar you receive from a digital platform is now a potential data point contradicting your VA claim status. The complexity arises because the income itself may not be taxable if offset by deductions. But the activity required to generate that income is what contradicts the VA benefits. This pattern requires meticulous documentation showing that the income stream is genuinely residual or managed entirely by others, with zero active involvement from the veteran receiving TDIU. This is a massive shift, moving the burden of proof onto the veteran to demonstrate non-involvement in the operation of any profitable venture. Where you live is now a data point. The system is hyper-analyzing. Pattern 2. The geographic relocation and healthcare. Mismatch. Veterans often receive compensation based on their inability to travel or their proximity to specialized care. The new analysis flags rapid, frequent, or unexplained changes in residency that conflict with established VA medical records. Imagine a veteran claiming severe mental health conditions requiring weekly in-person specialized therapy at a specific VA facility in Texas. If the IRS data shows the primary residence address changing to Florida, Montana, and then back to Texas within 18 months, the system immediately flags this instability. It's looking for the financial trail of relocation, moving truck expenses claimed as deductions, change of utility billing addresses, or sale of primary residences. and cross-referencing that with the claimed medical necessity for staying near a specific care provider. Furthermore, the system is now matching the cost of living adjustments, COLAs, associated with certain benefits to the actual reported cost of housing via mortgage interest statements, 1098s, or rental agreements. If you claim to live in a high-cost urban area justifying higher benefits, but your mortgage interest deduction suggests a property value far below the regional average, that discrepancy is now a flag. This pattern is particularly insidious because it targets the underlying premise of the benefit claim, the severity and location-specific needs of the disability. The new analytical model is sophisticated enough to track travel patterns too. High-frequency travel data, airline ticket purchases, toll road usage, or even aggregated cell phone tower data that contradicts a claim of being homebound or unable to travel long distances is a massive new red flag. They are looking for the financial signature of a life that is far more mobile and less restricted than the medical claims suggest. This is about behavioral economics meeting medical necessity. Are your tax dependents and your VA dependents telling two different stories? This leads us to pattern 3. The dependent ghost pattern. This flag occurs when there are significant unexplained discrepancies between the individuals claimed on the IRS 1040 form and those claimed for increased VA compensation. This is especially true for non-biological dependents, such as elderly parents, disabled siblings, or children from prior marriages. The IRS requires specific tests for dependency, including income limits and support requirements. The VA has its own criteria for dependency compensation. The new system is rigorously comparing the Social Security numbers SSNs listed on both forms. The primary flag arises when an individual is claimed as a dependent for VA benefits, significantly boosting the monthly payout, but that same individual files their own tax return reporting income above the IRS dependency threshold or is claimed as a dependent by another taxpayer. The ghost element comes into play when the dependent exists solely for the benefit application but has no verifiable financial presence in the veteran's IRS filings or local school/medical records. A major red flag is when a dependent is claimed for VA purposes, but the veteran never claims the related tax benefits, like the child tax credit or head of household status, suggesting a deliberate attempt to keep the dependent's financial status opaque to the IRS. Furthermore, the system is now analyzing the financial support flow. If a veteran claims to provide 100% support for an elderly parent to receive VA dependency compensation, but the parent's own bank records, which the IRS can access via information sharing agreements, show significant independent income or large gifts from a non-veteran source, the support claim is challenged. This pattern is designed to eliminate double-dipping and fraudulent claims where dependents are maintained on the VA roster long after they cease to qualify under financial or residential guidelines. Transparency is the only defense here. Both agencies must see the exact same financial reality for every claimed individual. Forget bank accounts. The new scanner is pointed at the blockchain. Pattern 4. High-frequency digital asset trading. The unreported gains loop. While VA disability compensation itself is tax-free, any gains realized from investing that compensation are absolutely taxable. The IRS has dramatically increased its surveillance of cryptocurrency exchanges, DEFI platforms, and digital asset marketplaces. The new flagged pattern involves veterans who show a financial profile consistent with high-frequency trading, dozens or hundreds of transactions per year, but report zero or minimal capital gains on their Schedule D. The joint analysis flags this when the VA data shows a consistent, substantial monthly income, the disability payments, that suddenly disappears from traditional banking accounts and reappears as large, unexplained deposits or withdrawals from digital asset exchanges. The flag isn't just about the unreported gains, it's about the volume of activity. High-frequency trading suggests active management and potentially constitutes a taxable business, especially if the trading involves complex derivatives or margin accounts. The IRS is using sophisticated tracing tools to follow the movement of funds from the tax-free VA deposit into the taxable investment sphere. If you are leveraging your tax-free compensation to generate significant taxable profits, and those profits are not accurately reported, the Joint Data System will identify the source funding, VA payments, and the resulting gains, taxable income, in one consolidated report. This pattern is often missed by traditional audits because the gains might be spread across multiple smaller exchanges. However, the 2026 systems are consolidating all 1099B and 1099DA forms, matching them against the veteran's primary income source, and flagging any high-volume trader who reports an AGI inconsistent with their trading activity. The assumption is simple. If you trade that frequently, you must have realized gains, and the tax-free nature of your source funds does not exempt the profit. They're watching the rhythm of your financial life. Pattern 5. The chronic claim shopping loop. This pattern is less about income and more about the manipulation of financial stability to meet needs-based criteria, particularly for programs like aid and attendance or certain hardship waivers. The system flags a rapid, repetitive cycle of asset liquidation, transfer, or restructuring that occurs immediately before a major VA benefit application or needs-based reassessment. The shopping aspect refers to the frequent opening and closing of different investment vehicles, moving money from a brokerage account to a specific trust, then dissolving the trust and moving the funds into an annuity, all within a short 24-month window. The system views this financial instability as manufactured. The flag is triggered when the veteran's net worth appears to artificially drop below the eligibility threshold for a needs-based benefit, only to see the funds reappear or be transferred back shortly after the benefit is approved. The IRS data provides the trail of the asset movement, 1099 RS, K1s, and bank transfer records, while the VA data provides the timing of the benefit application. The joint analysis is looking for the signature of asset hiding. This is a highly complex pattern detection mechanism that targets intent. If you liquidate a large portfolio, claim hardship, and then the liquidated funds are immediately used to purchase a large, non-income producing asset, like luxury goods or a vacation home, the system flags the transaction as an attempt to shelter liquid assets from the needs assessment. The solution here is meticulous documentation, proving that asset restructuring was for legitimate estate planning purposes and not solely to meet an arbitrary financial threshold for benefits. Any movement of significant capital must be justified with a clear, non-benefit-related financial strategy. You cannot deduct what the government already paid for. Simple, right? Not anymore. Pattern 6. The business expense overlap. This is a classic double-dipping scenario, now amplified by data matching. It primarily targets veterans who own small businesses, Schedule C filers, and deduct expenses that have already been reimbursed or covered by the VA, TRICARE, or other federal programs. A common example involves medical travel. A veteran might travel long distances for specialized VA care, and the VA reimburses the mileage and lodging costs. If that same veteran owns a business and deducts the exact same mileage and lodging costs on their Schedule C as a business travel expense, that is a fraudulent overlap. The new system is matching the travel reimbursement records provided by the VA against the expense deductions claimed on the IRS return. Another major flag involves durable medical equipment or home modifications. If the VA provided a grant or direct payment for a wheelchair ramp or specialized vehicle modification, the veteran cannot then turn around and claim that expenditure as a business necessity or a medical deduction on their taxes. The system is designed to catch these duplicative claims instantly. The flag is triggered by the precise dollar amount match between a VA disbursement code, for example, specific codes for home modifications or specialized transport, and a corresponding expense line item on the tax return. This pattern also extends to education benefits. If a veteran receives GI Bill funds or vocational rehabilitation payments, they cannot deduct the cost of the tuition or training materials on their 1098-T if those costs were covered by the tax-free benefit. The key takeaway is this: if a federal agency paid for it, you cannot claim it as a loss or an expense against your taxable income. The joint system eliminates the plausible deniability that existed when these records were kept separate. The biggest red flag isn't income, it's the disappearance of assets. This brings us to Pattern 7, the Wealth Migration Signature. This pattern focuses on large, unexplained transfers of wealth occurring within the look-back period for specific VA needs-based benefits, often involving transfers to family members or complex non-revocable trusts. This is similar to Pattern 5, but focuses specifically on the recipients of the funds. The new system is cross-referencing the veteran's IRS gift tax filings, Form 709, and large bank transfers with the financial profiles of the recipients. The flag is triggered when a veteran transfers a significant portion of their net worth to an adult child, and then that adult child subsequently reports a financial transaction that benefits the veteran, such as paying the veteran's mortgage, covering their utility bills, or making a large deposit into a joint account. This suggests the transferred wealth was not a true gift, but a temporary maneuver to lower the veteran's reportable assets for benefit qualification. The IRS tracks the transfer, the gift, and the VA tracks the resulting eligibility for aid. The joint system then tracks the financial behavior of the recipient. If the recipient of the gift uses the money primarily to support the original donor, the veteran, the system flags the transaction as potentially manipulative. Furthermore, the IRS is now sharing data on foreign account reporting, FBAR, and complex trust structures with the VA. If a veteran moves assets into an offshore account or a sophisticated trust immediately prior to a claim, the system views this as intentional asset concealment, especially if the veteran retains any level of control or access to the funds. The 2026 data analysis is sophisticated enough to map the financial relationships between the veteran and their beneficiaries, looking for circular money flows that negate the premise of the benefit application. This is the highest level flag indicating a potential scheme to misrepresent true financial standing. The days of assuming the IRS won't talk to the VA are over. The sheer volume of data being combined and analyzed means that your financial profile is now completely transparent. The 7 patterns we discussed, from the digital side hustle conflicting with TDIU, to the geographical mismatch with healthcare needs, to the intentional migration of wealth, are the new tripwires. This enhanced scrutiny is not about catching every honest mistake. It's about using technology to identify statistical anomalies that suggest intentional misrepresentation or significant unreported taxable income. The key takeaway is preparation. If you fall into any of these patterns, you must immediately ensure your documentation is flawless. You must be able to prove that your income is genuinely passive, that your dependents truly qualify, and that your financial restructuring serves a legitimate, non-benefit related purpose. Accuracy is your best defense. Don't wait for the letter. Review your 2026 filing strategy now before the algorithms flag your unique financial signature.